Good morning. This is Mag 7 Intel for February 4th, 2026. The monolithic rising tide of AI growth has officially fractured into what we are calling the Great AI Decoupling. While the January earnings cycle was once a collective celebration of GPU counts, the market is now ruthlessly distinguishing between those delivering immediate monetization and those disappearing into a black hole of infrastructure bottlenecks. The definitive contrast today is Meta Platforms versus Microsoft. Meta's stock surged over 10% following a monster quarter, adding nearly $200 billion in market value, while Microsoft suffered a historic 10% slump, a $350 billion haircut. This $550 billion market cap swing between two former AI twins marks the largest trading divergence in their shared history. Meta is winning through an invisible AI strategy, embedding llama-powered models directly into its ad recommendation engines to drive a 10% surge in ad efficacy. Microsoft, meanwhile, has hit the reality wall, a physical constraint where data center construction delays and power grid limitations prevent them from deploying newly purchased chips at scale. The hard numbers confirm this CapEx reckoning. Microsoft's quarterly capital expenditure hit a staggering $37.5 billion, representing a 66% year-over-year increase, yet Azure growth decelerated to 31%. In contrast, Meta has used its 41% operating margins to confidently raise its 2026 CapEx guidance to between $115 billion and $135 billion. Investors are rewarding Meta because this spending is viewed as high-margin internal optimization. Furthermore, Amazon has entered the fray with a strategic pivot, announcing a $50 billion investment to add 1.3 gigawatts of compute capacity specifically for AWS top-secret and GovCloud regions. This is part of a broader $100 billion data center expansion budget aimed at removing technological barriers for federal agencies. Meanwhile, NVIDIA reported record data center revenue of $51.2 billion for its last quarter, up 66% year-over-year, as it prepares to transition from the Blackwell architecture to the industry-resetting Rubin platform later this year. Our clinical analysis identifies three core insights shaping the next 5 years. First, the reality wall is no longer a theory, it is a physical limit on growth where electricity, not chips, is the primary bottleneck. Second, we are observing a capabilities overhang. Microsoft CTO Kevin Scott recently noted that current AI models are way more powerful than what people are using them for, creating a gap where the challenge is application, not just build-out. Third, the inference cost barrier remains a significant hurdle. Scott cited roughly $150,000 per year in inference costs for ambitious coding agent teams, which currently limits adoption to a narrow economic segment. Over the next 5 years, the physical AI leaders like Tesla, which is pivoting from automotive to robotics with a $20 billion 2026 CapEx budget, will face extreme execution risk as they trade 4.6% operating margins for the promise of the Optimus humanoid robot. Today's tactical focus is Alphabet, GOOGL, which reports after the close as the final litmus test for the $4 trillion club. Alphabet has successfully leapfrogged Apple in market cap and maintains a full-stack advantage through its Ironwood TPUs and Gemini 3 integration. Trade thesis. Institutional sentiment is bullish following its deal to power Apple Intelligence, with 70% of Google Cloud customers already utilizing its AI products. Execution. Entry zone is $340 to $345. Options imply a 5.5% post-earnings move. Targets. A beat and raise could test the $350 to $360 resistance level. 16. Support is firmly pegged at $310 based on current gamma levels and the rising 20-day moving average. In a market where the aggregate weight of the top 10 S&P 500 companies has finally fallen below 40%, stock picking and sector allocation are paramount. To receive our full institutional audit of the Mag 7 CapEx cycle and our proprietary reality wall tracker, subscribe to Mag 7 Intel at the link below. Stay clinical, and we will see you at the opening bell.